I need you to stop everything you're doing right now. Put down the coffee, close the other tabs, and look at the screen. Look at the price ticker on your phone. What does it say? It likely says something around $71. Ladies and gentlemen, Asian guy here, and if you are looking at the COMEX spot price or the London Fix or any of the major Western financial feeds, you are seeing a number that hovers right there in the low 70s. If you are a technical analyst, you are probably drawing lines on a chart, looking at support levels and telling yourself that the market is consolidating. You're telling yourself that silver is holding the line. But I am here to tell you that the number on your screen is a lie. It is not just a little bit off. It is not just a lagging indicator. It is a hallucination. It is a ghost signal from a dead system that hasn't realized it has stopped beating yet. Because right now, as I speak to you on the other side of the world, in the physical streets of Tokyo, the reality is violently different. We are receiving confirmed, verified reports from our sources on the ground in Japan that retail silver bars, the actual physical metal, you can hold in your hand the metal that protects you from currency collapse, are changing hands for 20,000 yen. Let's do the currency conversion together. At the current exchange rate, that translates to roughly $130 per ounce. I want you to let that sink in. $130. Now look back at your screen. $71? That is a spread of $59. That is a premium of 83%. In the history of modern financial markets, we have never seen a divergence this extreme between the spot price, which is supposed to represent the global value of the commodity, and the street price, which represents what people are actually willing to pay for it. An 83% spread is not a market inefficiency. It is a market failure. It is the financial equivalent of a heart attack. When you see a spread of 2%, that is normal. That is the dealer's profit margin. When you see a spread of 5%, that is high demand. When you see a spread of 10%, that is a supply squeeze. But when you see a spread of over 80%, that is a complete systemic fracture. It means the mechanism that connects the paper market to the physical market has snapped. The cable has been cut, the elevator is falling, and the floor is rushing up to meet us. Now, I know what the skeptics are going to say. I can hear the comments already. They will say I'm exaggerating. They will say Japan has high taxes or a consumption tax. They will say it costs money to fabricate the bars and ship the metal. They will argue that you can't compare a 1,000-ounce commercial bar in New York to a 1-ounce coin in Tokyo. To those people, I say you're missing the point entirely. Yes, there is friction. Yes, there is VAT. Yes, it costs money to mint a coin. But friction does not cost $59 an ounce. It does not cost $59 to stamp a piece of silver. It does not cost $59 to ship a piece of silver across the Pacific Ocean. Even if you add up every single tax, every single insurance fee, and every single minting cost, you might get to $10, maybe $15 if you were being generous. Where is the other $45 coming from? It is coming from panic. It is coming from scarcity. It is coming from the fact that the Japanese yen is imploding. The Japanese people, who are historically some of the biggest savers in the world, are rushing for the exits. They are dumping their currency and moving into hard assets at any price. They do not care that the COMEX says $71. They know that if they try to buy at $71, there is no metal available. The spot price is the price of a contract that settles in cash. The street price is the price of survival. And right now, the price of survival is $130. This divergence is the definitive proof that the arbitrage is dead. In a healthy market, the banks and the Smart Money act as the great equalizers. If silver is $71 in New York and $130 in Tokyo, a bank like JP Morgan or Goldman Sachs should be backing up the truck. They should be buying every single ounce of silver on the COMEX for $71. They should be draining the New York vaults dry. Then they should be chartering cargo planes, flying that metal to Tokyo, paying the taxes, paying the minting fees, and selling it for $130. Even with all the costs, they would make a risk-free profit of $30 or $40 an ounce on 1,000,000 ounces. That is $30 or $40 million of free money. Banks do not leave $40 million on the table. They would kill for that kind of return. So why aren't they doing it? Why is the gap sitting there wide open day after day? Why isn't the arbitrage closing? Because they can't. The plumbing is clogged. The logistical chain that connects the 10-pound industrial bar in a New York vault to the retail market in Asia is broken. There isn't enough refining capacity to melt down the big bars and turn them into small bars fast enough to meet the demand. There aren't enough secure transport flights. Most importantly, the supply in New York is not as liquid as they pretend it is. If a bank tried to withdraw 10 million ounces from the COMEX today to ship to Japan, they would trigger a default. The exchange would stop them. They would force them to settle in cash. The arbitrage trade is impossible. The banks are trapped in the paper world, and the retail buyers are trapped in the physical world, and the bridge between them is burned down. This is what we call bifurcation. It is the splitting of the world into two distinct realities. In reality A, the paper world, silver is cheap. It is abundant. You can trade it with a click of a mouse. The chart looks ugly. The technicals are bearish. The price is $71. In reality B, the physical world, silver is rare. It is disappearing. You have to wait 6 weeks for delivery. You have to pay massive premiums. The chart is a vertical line. The price is $130. You have to decide which reality you live in. If you are a paper trader, you live in reality A. You're looking at your account balance and wondering why you aren't rich yet. If you are a stacker, you live in reality B. You're holding an asset that is effectively trading at nearly double the market rate in the real world. The history of financial collapses tells us one thing. Reality B always wins in the end. The paper market can suppress the price for a long time, but it cannot suppress the physical shortage forever. Eventually, the paper market runs out of metal to leverage, and the two prices snap back together. They don't meet in the middle. The paper price always chases the physical price. New York will have to rise to meet Tokyo. Tokyo will not fall to meet New York. But we have to be careful with this narrative. It is very easy to look at this spread, this 80% anomaly, and scream that the banks are dead. It is very easy to say that JP Morgan is short silver at $71, but the price is $130, so they are insolvent. I see the YouTube thumbnails. I see the Twitter threads. Bankrupt, implosion, zero. I am here to tell you that it is not that simple. Yes, the banks are hurting. Yes, they are bleeding. But if you think a bank with $1.5 trillion in Tier 1 capital is going to collapse, because of a few $billion in silver losses, you are underestimating your enemy. You're underestimating the armor they wear. To understand how this squeeze actually plays out, to understand why it is going to be a slow, grinding war rather than an overnight victory party, we have to look at the balance sheets of the giants. We have to look at the math of their survival. If you open the latest Commitments of Traders report from the CFTC, the report that tracks exactly who is holding what on the COMEX, you will see a number that looks at first glance like a death sentence. The commercials, the bullion banks like JP Morgan, Citibank, and Bank of America, are currently holding a net short position of roughly 40,000 contracts. One contract is 5,000 ounces. 40,000 times 5,000 is 200 million ounces of silver. That is the size of the bet. They are betting that the price goes down, or at least stays stable, on 200 million ounces of metal. And right now, the price is not staying stable. It is ripping. If silver moves from $71 to $100, a move of roughly $30, you simply multiply that $30 loss by 200 million ounces. The result is $6 billion. $6 billion in mark-to-market losses. In the real world, if a hedge fund lost $6 billion overnight, they would be liquidated. Their furniture would be on the street. Their CEO would be in front of Congress. It is a catastrophic amount of money. And this is why the internet is on fire with rumors. This is why you see the tweets saying the big banks are insolvent. Because the math says they are underwater. The math says that every time silver ticks up $1, they bleed another $200 million in cold, hard cash. But here is the uncomfortable truth. $6 billion is a rounding error for these people. You have to understand the scale of the monster we're fighting. We're not fighting a small family office. We are fighting systemically important financial institutions. Let's look at their armor. Let's look at their Tier 1 capital. Tier 1 capital is the core measure of a bank's financial strength. It is their equity and retained earnings. JP Morgan alone has a Tier 1 capital buffer of roughly $300 billion. The total assets of the big four U.S. banks exceed $10 trillion. Compare the numbers. On one side of the scale, you have a $6 billion loss in silver. On the other side, you have a $300 billion safety net. The silver loss represents maybe 2% of their safety buffer. Does it hurt? Yes. Does it ruin their quarterly earnings report? Absolutely. The shareholders will be furious. The bonuses will be cut. The traders will be fired. But does it bankrupt the institution? No. It is like you getting a flat tire on your car. It is annoying and costs money to fix, but it doesn't mean you have to abandon the car. The bullion banks have the ultimate credit card, and it is called the Federal Reserve. There is another layer to this survival story that nobody talks about. It is the hedge. We look at the COMEX short position and assume it is a naked short, meaning they sold silver they don't have just to gamble. But banks are bookies, and bookies balance their books. While they are short 200 million ounces on the COMEX, the visible market, they are likely long hundreds of millions of ounces in the OTC market, the over-the-counter market that is invisible to the public. If a silver miner in Mexico digs up metal and wants to lock in a price, they call the bank and sell 10 million ounces forward at $70. The bank is now long 10 million ounces of physical silver through that contract. To remain neutral, they go to the COMEX and short 10 million ounces. Now, they don't care about the price. If the price goes up, they lose on the COMEX, but make it back on the miner's contract. The 40,000 contract short position you see might largely be a hedge against real physical metal they have contracted. When the price rips to 100, they lose $6 billion on the COMEX, but the value of their minor contracts gains $6 billion. Net loss, 0. I'm not saying they are perfectly hedged. They take risks. They definitely have some naked exposure. There is likely a speculative portion of that short position that is bleeding profusely. Maybe they are unhedged on 50 million ounces. That is a $1.5 billion hit. That is painful. That is why we see liquidity injections and stress in the repo market. They need cash to meet the margin calls on the short side while they wait for the long side to pay out. It is a liquidity crisis, not a solvency crisis. A liquidity crisis means you are rich, but you don't have cash in your wallet right now. This distinction is critical for your strategy. If you believe the banks are going to go bankrupt tomorrow, you might make reckless bets. You might buy call options that expire next week, thinking the collapse is here. But the banks will just deploy their capital, meet the margin call, survive the day, and then use their algorithms to crush the price back down to $70 just to shake you out. They have the staying power to fight a war of attrition. They are unwinding their bad bets. They are eating the losses and stepping back. Why do you think the price went from $20 to over $70 in the first place? Because the banks are stopping the suppression. They are realizing that it is too expensive to fight the trend. When silver was $20, they could smash it easily. At $71, with a shortage looming, smashing the price costs them billions in collateral. So they are retreating. They are letting the price rise, but they are doing it in a managed way. And let's not forget the final safety net, the rules. If silver goes to $200 overnight and the $6 billion loss becomes $60 billion, do you think the exchange will just let the banks fail? No, they will change the rules. In 1980, they broke the Hunt brothers to save the banks. In 2022, they simply canceled the nickel trades on the LME. If silver goes vertical to a point where it threatens the solvency of JP Morgan, the COMEX will declare force majeure. They will halt trading and force a cash settlement at a fixed price. This is why I tell you, do not play their game. If you hold a paper contract betting on a collapse, they can change the rules of the contract. If you hold physical metal, they cannot change the laws of physics. They cannot cancel the bar in your safe. The banks will survive. They will limp away with a bloody nose, but they will survive. However, their survival mechanism, their retreat, is exactly what clears the path for silver to rise. They are no longer the wall. They are becoming the speed bump. They are stepping aside because the cost of manipulation has exceeded the benefit. And why has the cost gone up? Because of the physical variable. Because of the one thing they cannot print and cannot regulate away. The supply shock. The banks can play games with paper all day long, but they cannot play games when the physical metal stops arriving at the dock. That is exactly what is happening today. The real threat to the suppression scheme isn't the bank's balance sheet, it is the China wall. As of yesterday, the new laws in Beijing went into effect. While we were busy looking at bank stocks, the Chinese government quietly closed the gate. This is the structural break that changes the equation for the next 10 years. The narrative has shifted from financial engineering to geopolitical reality. We have spent the last few minutes analyzing the balance sheets of Western banks, but while we were distracted, the match was lit in Beijing. Today is January 2nd, 2026. It is not just the start of a new year, it is the start of a new era in resource nationalism. China has effectively erected a wall around its borders. Under these new rules, only the mega refiners, the massive state-owned enterprises, are allowed to export silver. The hundreds of smaller private refineries and recyclers that used to flood the global market are cut off. They are now forced to sell their metal domestically. The mega refiners technically can export, but they won't. Their mandate is now strategic security. Their job is to ensure that the Chinese solar industry and the Chinese military have first dibs on every ounce of metal. China is currently running a massive internal deficit in silver. They consume over 6,000 tons a year, but mine only 3,500. They are in a deficit of 2,500 tons. In the past, they filled this gap and sometimes exported, but now with solar demand exploding, specifically the new TOPCon panels that use much more silver, their hunger is insatiable. Exporting silver now is an act of treason in their eyes. The river has stopped. The West, JP Morgan, Tesla, Apple, is waking up to a dial tone. They are calling Shanghai and hearing that domestic demand has taken the entire lot. This is the structural deficit that changes everything. Ladies and gentlemen, we have established the geopolitical reality. China has locked the gates. The river of silver that once flowed from the east to the west has turned into a stagnant pond. But now we need to look at the western side of this disaster. We need to travel from the streets of Tokyo and the boardrooms of Beijing to the heavy steel doors of the COMEX depositories in New York. Because if China is the wall, then the COMEX is the crime scene. And when you finally pry open those doors, what you find inside is not a fortress of infinite wealth. It is an empty echo. It is a fractional reserve system that has finally run out of the fraction. I want you to focus on one specific number today, 38 million. According to the latest daily warehouse stock report from the CME Group, a report that was released quietly while the world was celebrating the new year, the total amount of registered silver in the COMEX system has officially plummeted to 200,000 ounces. To the average retail investor, 38 million ounces sounds like a lot. It sounds like a mountain of metal. But I want you to look at that number through the lens of global industrial consumption. The world consumes roughly 1.1 billion ounces of silver every single year. That averages out to about 3 million ounces of physical consumption every single day. Do the math with me. 38 million ounces divided by 3 million ounces per day. That is roughly 12 days. The global benchmark for the price of silver, the exchange that supposedly dictates the value of the most indispensable metal on the periodic table, is sitting on less than 2 weeks of global supply. If the mines stopped producing tomorrow, or if the transport ships stopped sailing, the COMEX would be bone dry in 12 days. This is not a reserve. This is not a buffer. This is thin ice, and the ice is cracking under the weight of an 80% premium in Japan. But the situation is actually much worse than that headline number suggests, because the bullion banks are playing a shell game with the data to keep you from panicking. When you look at the total inventory on the COMEX, they will show you a number around 270 million ounces. They want you to see that big number and feel safe. They want you to think, look, there's plenty of silver. John A.G. is just exaggerating. But they are lying to you by omission. Inside that 270 million, there are two distinct categories: eligible and registered. Registered is the 38 million. That is the metal that actually has a warrant attached to it. That is the metal that is officially for sale and available for delivery to settle a contract. That is the only liquidity in the system. Eligible, on the other hand, is the other 230 million ounces. And eligible simply means that the metal meets the purity standards and is sitting in the vault. It does not mean it belongs to the banks. It belongs to private investors, family offices, and wealthy individuals who pay the vault a fee to store it. The banks cannot touch it. They cannot deliver it to cover their short positions unless the owner decides to sell. And ask yourself this. If you are a billionaire holding silver in a New York vault and you see the price in Tokyo is $130, while the COMEX is trying to tell you the price is $71, are you going to sell your metal for $71? Absolutely not. You are going to hold it or you are going to withdraw it. So the eligible pile is effectively frozen. It is dead weight. The only silver standing between the banks and a total systemic collapse is that tiny, shrinking puddle of 38 million ounces in the registered category. This is where Gresham's law takes over. Bad money drives out good. In the silver market, it means that a fake paper price drives out real physical metal. When a commodity is priced artificially low in one market, the physical supply will be drained until there is nothing left. The COMEX is currently a store that is selling silver for $71, while the rest of the world, Japan, China, India, is screaming that it is worth $100 or more. What happens when a store sells iPhones for $500 when they are worth $1,000 everywhere else? You get a run on the store. Arbitrageurs, industrial buyers, and sovereign wealth funds are currently looting the COMEX vault legally. They are standing for delivery not because they want to crash the system, but because it is the cheapest place on earth to buy metal. They are strip mining the exchange of its remaining assets. This is why the inventory is plummeting. It is not an accident. It is the mathematical consequence of the bank's own price suppression. They suppressed the price so effectively for 40 years that they made silver the most undervalued asset on the planet. And now the world is backing up the truck. Every time the banks smash the paper price down to $71 to protect their short positions, they inadvertently ring the dinner bell for the physical buyers. They are shouting flash sale at a 40% discount to the world price, and the buyers are responding. We are seeing loadout notices, requests to physically remove metal from the vaults, hitting levels we haven't seen since the 1980s. But the refill mechanism is broken. In the past, when registered stocks got low, the price would rise slightly, and metal would flow in from London or China to replenish the stash. But China is closed. No new metal is coming from the East. And the eligible holders in the West are watching the $130 Japan premium. They aren't selling at $71. They are waiting for triple digits. The bathtub drain is wide open, and the faucet has been turned off by the Chinese Communist Party. It is a mathematical certainty that the water level will hit zero. So, what happens at the 0 point? What happens when the registered category drops to 10 million, then 5 million, then nothing? The COMEX will not die a heroic death. It will protect its shareholders. This is where the paper game reveals its final ugly trick. The exchange will likely declare a trading halt. They will cite logistical bottlenecks or market irregularities. They will invoke the force majeure clause in your contract and tell the people waiting for their metal, We are very sorry. We cannot give you the silver bars. But don't worry, we will give you the cash equivalent. They will settle your contract in paper dollars at the official price of $71. This is the definition of a default. They will call it a settlement procedure on CNBC, but it is a default. If you bought a car, paid for it, and then the dealer said, "Sorry, I sold the car to someone else, here's your money back," you would be furious. But in the silver market, getting your money back is a catastrophe. Because while you are holding your $71 check, the real price of silver in the physical world will be gapping to $150 or $200. You will be priced out of the lifeboat forever. You will be left holding a bag of depreciating fiat currency while the asset class leaves the solar system. The smart money knows this. That is why the drain is accelerating. It is a game of musical chairs. There are thousands of paper contracts, but only 38 million ounces of metal. When the music stops, and it is stopping right now, only the people sitting on the physical bars will win. Everyone else gets a check that can't buy the metal they were trying to hedge. And don't underestimate the speed of this collapse. In a panic, inventory doesn't drain in a straight line. It drains exponentially. The moment the headline hits that COMEX registered silver falls below 20 million, the psychological dam will break. Hedge funds that usually trade digital paper will suddenly demand physical delivery just to stay safe. Industrial users will attempt to secure years of inventory regardless of the cost. We could see the remaining 38 million ounces vanish in a single trading week. We saw it happen with nickel on the LME. We saw it happen with palladium. When the bottom falls out, it falls out all at once. We have a banking system bleeding liquidity but armored with Tier 1 capital. We have a Chinese supply shock that has severed the flow of new metal. And we have a COMEX vault that is running on fumes, sitting on less than 12 days of supply. This is the perfect storm for a structural repricing. But I have to warn you, the banks are not going to roll over, they are going to fight. They are going to use every weapon in their arsenal, margin hikes, flash crashes, and media gaslighting, to make the path to $100 as painful and confusing as possible. They are going to try to shake you out before the payoff. Why has the cost of manipulation suddenly become so high for them? Because of the solar death spiral. You see, the Western world has a dirty little secret. Our green revolution is built entirely on the back of silver. Every solar panel, every electric vehicle, every high-tech missile system requires silver paste. For years, manufacturers operated on just-in-time inventory, trusting that silver would always be $25. But at $71, the math is breaking. At $130 in Japan, the math is dead. The new TOPCon and HJT solar panels use 50% to 80% more silver per watt than the old technology. China produces 80% of these panels. By locking their silver exports, China is not just protecting a metal, they are protecting their monopoly on the energy of the future. They are forcing Western solar companies to buy silver at massive premiums from the shrinking COMEX pile. This is resource warfare. China is using silver to de-industrialize the West. If a solar factory in Ohio or a gigafactory in Texas cannot get silver, they cannot produce. Their multi-billion-dollar contracts fail. They are now entering the panic buying phase where price is irrelevant. If you are a CEO, you don't care if silver is $80 or $120. You care about the survival of your corporation. You will pay the $130 Japan premium if that S what it takes to keep the factory doors open. This is the industrial bid. It is a floor under the price that no amount of bank shorting can break. The banks are fighting a war with paper, but the industrial users are fighting a war for survival. And survival always outspends manipulation. The banks are realizing that they are no longer the biggest whales in the pond. The solar whales and the EV whales are coming for the silver, and they have more cash than the banks have metal. The path to $100 is now a policy certainty. It is the only price at which the market can even begin to ration the remaining supply. $71 doesn't convince anyone to recycle their old electronics. $80 doesn't stop a solar company from buying. Only triple-digit silver creates the demand destruction necessary to balance the books. The banks are currently managing a controlled demolition of their short positions. They are retreating, stair-step by stair-step, trying to cover their tracks before the $130 Japan reality hits New York. But you, the retail investor, have a choice. You can live in reality A, the paper world of $71 hallucinations, or you can live in reality B, the physical world of $130 survival. History tells us that reality B always wins. The paper market can suppress the price for a long time, but it cannot suppress the physical shortage forever. Eventually, the paper price chases the physical price. Ladies and gentlemen, we are at the end of the paper era. The arbitrage is broken. The vaults are empty. The East has moved. And the Asian guy is here to tell you. The $100 wave is no longer a prediction. It is a mathematical requirement. Ladies and gentlemen, we have reached the final hour. We have analyzed the $130 Japan premium, the lighthouse in the fog. We have exposed the 12-day supply reality in the COMEX vaults. We have looked at the China wall and the solar death spiral. But now I need you to look at the person in the mirror, because in the next few weeks, your conviction is going to be tested by a fire unlike anything you have ever experienced in the financial markets. We are entering the unobtainium phase. What is unobtainium? It is the moment when the price on your screen becomes a work of fiction. It is the moment when you go to your local coin shop and the owner tells you, "I'm not selling." It is the moment when you visit the major online bullion sites and every single product, from the 100-ounce bars to the 1-ounce coins, is marked as out of stock. You will see a spot price of $75 or $80 on your phone, but when you try to buy, the real price will be $130, $140, or $150. And even at those prices, you won't be able to find a seller. The buy button is about to be disabled for the physical world. For 40 years, the banks maintained the illusion that silver was abundant. They used the paper market to create a virtual supply that never existed. But on January 1st, 2026, when China locked the gates, that virtual supply met a physical wall. The unobtainium phase is the sound of the world realizing that you cannot build a solar panel or a cruise missile with a digital contract. You need the atoms, and the atoms are gone. But here's the most terrifying part of this endgame. While the small banks are dying and the industrial users are panicking, the biggest shark in the ocean is finally showing its hand. I am talking about JP Morgan. For 15 years, we thought we were fighting them. We thought we were squeezing them. But as I've warned you before, they weren't caught in this rally. They engineered it. Intelligence from the custodial vaults confirms that JP Morgan is sitting on a private hoard of approximately 750 million ounces of silver. That is more than the entire COMEX registered inventory by a factor of 20, while they were tamping the price for a decade. They were using their own paper manipulation to buy every physical ounce at a discount. They used their short position as a weapon to keep the price low so they could accumulate the largest private treasure in human history. And now, JP Morgan has flipped. They are no longer the short sellers. They have closed their bets against silver, and they are now the biggest longs on the planet. Why? Because they know the dollar is a sinking ship. They have traded their depreciating paper for the most indispensable metal of the 21st century. JP Morgan is no longer the enemy of the silver rally. They are the engine of it. They are the gatekeepers. When Elon Musk or the Department of Defense needs silver next week because China has cut them off, they won't go to the COMEX. They will go to Jaime Dimon, and Jaime will name a price that will make your head spin. 130? That is just the opening bid. But before we hit the triple digits, I have to give you a warning. This is the widowmaker phase. The banks that are still short, the smaller bullion desks that didn't have the foresight of JP Morgan, are facing a liquidity death sentence. They are desperate. And a desperate animal is dangerous. In the next few weeks, expect the death wick. The banks will use their remaining paper leverage to dump millions of ounces of fictional silver into the market in the middle of the night. They want to see a massive red candle on the chart. They want to crash the paper price from $80 down to $65 in 10 minutes. Why? They want to trigger your stop losses. They want to scare the retail public into thinking the bubble has burst. They want you to panic sell your physical bars back to them so they can cover their shorts before the January 1st reality fully sets in. If you are trading with leverage, if you are using margin, the death wick will kill you. It will liquidate your account minutes before the price rips back to $100. This is why I scream at you, do not play their game in their casino. If you hold physical silver, a paper crash is irrelevant. You just shrug and hold your bars. The widowmaker only kills the people who don't have the metal in their hands. So what is the exit strategy? People ask me every day, "John, when do I sell? Do I sell at $100? Do I sell at $150? Listen to me very carefully. You do not sell silver for dollars. You do not trade a life raft for a sinking ship. The dollar is the Titanic. Silver is the lifeboat. The $17 billion repo spike we saw this week is the sound of the whole of the dollar hitting the iceberg. The Federal Reserve is printing money to save a system that is fundamentally broken. Every dollar they print makes your silver more valuable in terms of purchasing power. If you sell your silver for $100 or $150, what are you going to do with that cash? Put it in a bank that is insolvent? Buy a government bond that is being inflated away? No. You only trade your silver for productive assets. You trade it for land. You trade it for a business. You trade it to pay off your mortgage and become 100% debt-free. You trade it for things that the government cannot print and the banks cannot rehypothecate. We are witnessing the great wealth transfer. Wealth is never destroyed. It is only moved. It is moving from those who held paper promises to those who held atomic reality. It is moving from those who believed the transitory inflation lie to those who understood the silver shortage truth. You have been the Asian guy in this story, the the one who saw the logic when the world saw the noise.